Okay, well, we might make a start. So first of all, good afternoon, ladies and gentlemen, and welcome to the Munro Partners Investment Update. I'm Steve Fletcher on behalf of all the team at GSFM and Munro Partners. Thanks very much for tuning into the webinar today. Now, as we close in on the end of the financial year, we thought it would be a great time, very timely, to give you an update on what's going on within the Munro Global Growth Fund. And to do that, I'm joined by Munro's Chief Investment Officer and also co-founder, Nick Griffin. Welcome, Nick.
Thanks for having me, Steve.
Nick, now we've prepared, I know you've prepared a presentation obviously for today, but in terms of setting the scene, I'm not so sure I need to really probably set a scene for today. I think everyone knows it's been an absolute brutal 5.5 months in markets. As we sit here today, the year to date, the S&P is down 20+%. The Nasdaq's down more than 30%. And when you look at what's happened to stocks on an individual basis, in many cases, it's been a significant clean out. Just to name a few, Netflix is down 70%, PayPal down 60%, Spotify down 55%. As I said, just to name a few. So as discussed, what I think would be really useful for our clients on the call today is to talk about the year so far in terms of your positioning and also performance. The Fed's pivot in January really caught most off guard. However, you still managed to avoid the really big blow-ups. So providing an update on how you managed to do that and more broadly, how you've executed your risk management tools in more recent months, I think would be really useful for everyone on the call to understand. And then finally, Nick, I'm sure this is what everyone wants to hear is to understand, where to from here. What do you think the next 3 to 6 months looks like for equities? What are your earnings expectations from the companies that you own within your portfolio, and how, and importantly, how you have the Munro Global Growth Fund positioned from here? So there's a lot to talk about in the next 25 minutes, but with that, Nick, I'm going to hand over to you. So thank you.
Yeah, thanks very much, Steve. And thanks very much, everyone, for dialing in and for your interest in Munro Partners. So I'm not going to do the normal introductory remarks today. I think we'll cut straight to the chase pretty quickly and try and get to some of these big issues that you and obviously your clients want to know about. I will make two prefacing comments, though, just really quickly. So it's important to stress that the Munro Partners, our goal is to be your global growth manager. That's where we fit in your portfolio. So you do Australian equities, you do bonds. We want to be your global equity manager. Our tagline is invest in the journey. And look, the journey in growth equities is always bumpy. We have a 16-year track record of double-digit returns. And that's 16 years, that's 10 years at our previous firm and 6 years at Munro of doing double-digit returns after all fees and expenses. And unfortunately, it is not a straight line. It never has been, and it won't be. And right now, we're obviously in a bumpy part of that straight line. Just very quickly, before I dive into the market and some of the comments that Steve mentioned, I just wanted to flag really quickly, we will spend most of today talking about the Munro Global Growth Fund. We run 3 products here at Munro. We will spend most of the day talking about the Munro Global Growth Fund. It is our absolute return product, and it's the largest product we have here in Australia. It's important to stress the goal of that fund is to do double-digit returns per annum through the cycle. And as I said, it's done that for 16 years. And look, it is still doing that in 6 years of Munro, even though we are, at least halfway through our second bear market in the last 6 years. The goal of that product, as I said, is 10% per annum. It does have the ability to raise cash. It has had 40% cash in it since January. And I've been asked pretty much once a week since mid-January when we would put that cash back to work. And every week we sort of said, not yet, not yet, not yet. And so we will spend a lot of time today talking about the market and when we do want to put that cash back to work and why we raise that cash and should we raise more cash and what did we do with shorts and puts and stuff. I'll happily go through all of that. So most of the time we're going to spend talking about that. But I did just want to remind people, we do obviously run a long-only product, which is the Munro Concentrated Global Growth Fund. So if you think this is the bottom of the market today and you want to be fully exposed to growth equities, you can do it with our long-only product. And lastly, obviously, we run our climate product, which we launched back in October, which is really just to exploit these companies that can help enable the decarbonisation of the planet. All 3 are quoted on the Australian Stock Exchange and there for you to buy and sell as you see fit. And they should all trade in line with NAV because they are managed ETFs. But as I said, we will spend most of the time talking about Munro. So So the global growth fund. So let's cut to the chase. So what's going on in the market? Why has it been such a tough 5.5 months? And what do we think big picture, when this will finish? And so the first point I just want to make before we get into the nitty gritty is if you just take a big step back, big picture on a 3 to 5 year view, not a lot's changed here. We still think you're in a low interest rate environment. Okay. So this is just a good chart. I show it lots of times, and I'll just remind everybody one more time. This is the 10-year bond rate over the last 55 years or 60 years. This is the amount of debt in the US over the last 55 years or so. And so in my entire investment career, effectively something goes wrong, we lower interest rates and we raise more debt. Whether that's pre-financial crisis, then the financial crisis happens, we lower interest rates, we raise more debt, we rack up more debt. COVID comes along, we lower interest rates, we rack up more debt. This has been happening for decades. And even though we are dealing with a backup in interest rates here, and we understand that, and we'll talk about that, we do not see rates going back to these sort of stagflationary type areas. It's just not going to happen. And so while rates will go up and potentially overshoot, the reality is they will cause a slowdown. They will cause a slowdown and they will normalize back towards, we think, a lower number than post-GFC. Why? Because there's too much debt. Put simply, the reality is when you lower the rates, people go spend too much money, they rack up too much debt, and ultimately the equilibrium level of interest rates is lower than it was previously. So that's an important point, because a lot of people will tell you that, it's an inflationary environment, stagflation, the PE of the market has to go back to 7. Well, the PE of the market doesn't have to go back to 7 because rates aren't going to get to 10 or 12%. There won't be this alternative to invest in. And so importantly, medium term, we still think equities is the main game in town. Why? Because bonds aren't really going to give you the alternative that you're looking for. However, in the short term, we clearly have a problem. That problem is inflation. We and others in the market have underestimated this, and we've underestimated how ingrained it is. More importantly, you can say it's transitory, you can say it's China, you can say it's Ukraine. It doesn't really matter. The reality is it's here, and the Fed needs to do something about it. So they have to kill the economy to kill inflation. That's what they have to do. They've got to sort of burn it down to save it. And so the question you're asking now is like, how much do they have to kill the economy to kill inflation? And that's sort of the question the market's been wrestling with all year. Just to give you an idea of how far we've moved and why this is happening, and I suppose this is really quite important, is this just shows the dot plots for the FOMC, okay? So the FOMC in March 2021 thought there would be no rate hikes in the next 2 years. Philip Lowe here in Australia said rates wouldn't go up until 2024 or 2025. And he said that literally just 6 months ago. The reality is by December 2021, we thought there was 3 hikes. And by June 2022, they're now talking about 11 rate hikes this year, another 4 next year. The neutral level of interest rates getting to roughly 3.75%. Now, this is a huge move. In my career, you have never seen central banks move this quickly. And at the end of the day, this is really COVID's fault, okay? So COVID, came along, we put a lot of stimulus into the market. It created this huge boom. And then the problem is COVID went away just as quickly as it arrived. Basically, we all went away over Christmas. We all got COVID. Omicron came around, and you came back in January and realized that the COVID crisis was over. Now everyone's getting on planes, going everywhere. You have an inflation problem, and the Fed is miles behind the curve. And so you've had to make this move. The problem is this is going to cause damage. It's going to cause damage, firstly and clearly, to growth equities, because they're the most liquid and overvalued assets in the marketplace. And, that's largely happened. But don't think for 1 second that it's not going to cause damage in all sorts of other parts of the economy, whether it's in earnings or whether it's in property or whether it's in other areas, because quite simply, nobody expected this to happen. And even the central banks didn't expect this to happen, and they were telling you it wouldn't happen, and now it's happened. Similarly, at the long bond level, you're seeing interest rates go from 0.5% to 3%, again, causing, I said, a lot of damage to liquid assets, but it will eventually get to unliquid assets and other places. And so from that point of view, this has made the market very difficult this year. The best way to think about this in terms of, are we there yet? The market's obviously been difficult. So the question you obviously want to know is, yes, Nick, you just told us a lot of stuff we already knew, but is it priced in yet? Is it priced in? And, this is just a good, simple way of looking at the market. I'm showing you the S&P 500, but you could do the same thing for Australia. And so this question of, are we there yet? Should we be putting the money back to work? This is some of the stuff we're looking at. And so what I'm showing you here on the left is the S&P 500 over the last 10 years and the earnings, or the blended forward earnings per share of the S&P 500. So if you remember my MasterCard or Bank of America slide, you know, the reality is the S&P 500 is like any stock, it just follows its earnings. Importantly, the earnings of the S&P grow faster than the economy because it's not the economy, it's the best 500 companies. Grows at roughly 8%. So that's why equities are, you know, where you want to be in the long run. However, on the right-hand side, I'm showing you, this is the blended forward PE ratio of the market. So this is the S&P 500 and the forward PE multiple. And what you can see here is we had this huge re-rating through COVID. That re-rating was because we all thought, including us, that interest rates would stay lower for longer. The reality is that didn't happen. The reality is interest rates have normalized back to where they were pre-COVID because COVID went away, and the market has derated back to where it was pre-COVID. That makes sense. And so we're sitting here today at roughly 15 times earnings. Now, we would put it to you that this bit of the derating is largely done. The Fed is pricing in a lot of rate hikes. It's hard to see how we price in any more than this. And a lot of this derating's actually already happened. So this bit, the bad bit that we've been through, has already happened. The problem is on the left here is that the earnings forecasts have not rolled over yet. The earnings forecasts are still up very high. And I think it's, as I said earlier, it is simply unrealistic to expect that these level of rate hikes aren't going to cause damage to the economy. We can already see that damage happening. We can already see the damage happening to earnings. And so I'll just give you a couple of quick examples. I've just been over in the US for roughly a month. When I first got there, Target, which is a big retailer in the US, basically came out and said they're going to downgrade their earnings forecast by 30%. That 30% was because they basically had double ordered all this stuff that they needed for all this demand that we created through COVID. It didn't arrive because it was stuck in China or on the port and all these places. And then just when it arrives, nobody wants to buy it. And they have to discount the inventory. So they downgrade their guidance that they literally set 4 weeks earlier by 30%. That's because they have to cut the price on all these goods. And then just when I was leaving the US, roughly 3.5 weeks later, they turned around and said, actually, that 30% is not enough. We've got to cut it by more. They cut it by another 20%. So that's a 50% downgrade in basically the space of 8 weeks since they set the guidance. That's how quickly things are moving. I'll give you another good example. So happened to be in the room when Jamie Dimon gave his hurricane comments, you know, that ultimately spooked the market a little bit. We'd actually seen him 3 weeks before in a more private briefing where he was nowhere near as bearish, quite frankly. But he got more bearish as the time came on. And so what you're seeing here is a very rapidly moving picture, and it's all rapidly moving because these rates are being priced into markets. People are now adjusting. Hiring freezes are happening. People are essentially starting to sack people. This is all the vanilla things that you see in a slowdown. And so I do think it's quite realistic that these numbers are going to come down, and they're going to start coming down this quarter. And so the question you all want to know is, where does the market bottom? And it's pretty simple. There's some pretty simple maths you can do from here to sort of give you a range. If you think that 15 times PE is right, and we do think it's right, by the way, we think that's roughly right, then you've just got to decide, does the EPS go from 240 to 220 or 200? 15 times 220 gets you the S&P bottoming at roughly 3,400. 15 times 200 gets you to 3,000. We think that's probably a bit drastic. But the reality is we are having a vanilla slowdown off the back of the boom of COVID. The multiple's done it because of the rates. You've still got the earnings to go. And so from our point of view, we don't think we're quite there yet. And we do think it's a good time to still remain just conservative. There is one other option here, by the way, that the market already knows that this is going to happen and that the PE multiple goes lower. Anything below 14 times, you probably just start buying anyway and look through the valley of this particular downgrade. The other thing to think about just really quickly is what I showed you earlier on that slide, is the shift that is going to happen underneath the surface in the market. And you're already seeing this starting to happen today. And so what I'm showing you on the left, the two slides here, is sort of the difference, I suppose, between growth and value, or mainly between growth and cyclicals. On the left-hand side, I'm showing you the NASDAQ in between 1995 and 2003. And I'm plotting that against the Goldman Sachs unprofitable tech basket between 2016 and today. And what you can see and what you all know is this has been a prodigious growth sell-off. I mean, Steve mentioned the NASDAQ down more than 30% for the year. But under the surface, it's so much worse than that. And that's really been held up by these big cap companies like Microsoft, et cetera. And so from our point of view, this sell-off's sort of largely done. You know, you've seen unprofitable tech fall 75% from its peak. That's basically what it did in the dot-com era. And so this prodigious blow-up or derating has effectively happened. The problem you've got now is on the right, is the market's now, you know, Mr. Market's sniffing this out like they always do, that there is an economic slowdown coming. And this is just showing you financials and industrials. And you can see that they are starting to roll over. They're starting to roll over because the cyclical side of the economy is starting to roll over. You'll also see that the S&P is now not outperforming the NASDAQ anymore. And so this is unfortunately the bit that we have to go through, which is the slowdown. And unfortunately, we don't know how big it is. And that's why, you know, it does make sense to stay a little bit conservative. Relatively, we think growth outperforms value from here. Relatively, we think growth earnings resilience is going to be more helpful than cyclicals. But what we can't tell you, unfortunately, is whether the market's actually bottomed. And this is just another simple chart that we look at, is just to look at the equity risk premium and really just to put this into context. We show this all the time, but the equity risk premium is just the earnings yield of the S&P 500 minus the 10-year bond rate, the risk-free rate. And what you can see here is we've always shown this in the past to say, you know, the market's not that expensive, but it's also showing today the market's not that cheap. I.e. the equity risk premium today is exactly the same as it was on the 1st of January. Why? Because 10-year bonds have backed up so much. And so to get the market to bottom here, you either need an ERP of roughly 400 is what we'd be looking for. You get 600 in really bad times. We don't think this is a really bad time. 400 would be good enough. Or you need the bonds to start coming down, and the bonds start coming down will get you to that 400 number too. And that's the other thing that we'd be looking out for. Okay, so what are your key signposts to get to the end of this? I'm going to keep this really simple for you. It's just inflation. The Russia-Ukraine situation, the China lockdown situation are only relevant as to how much they are contributing to this inflation problem. This just shows you the inflation comping over the year. We actually built this slide 3 months ago to say, you know, this inflation situation should get better because you start comping higher numbers. It actually hasn't. And it really was this last inflation print in May that's given us the next leg lower in the market. Simple way to think about this is the higher inflation stays for longer, the more the Fed has to tighten to kill it, the worse the slowdown on the other side is going to be. And so these are the numbers that you need to watch really closely. They are the problem and they are ultimately the solution. So from our point of view, there's 3 key things we're looking for to put that cash back to work. And I know we've been asked a lot, and you know, it is obviously very tempting. There are a lot of great valuations here that we're going to talk about a lot in the second half of this presentation. And a lot of exciting areas that we're really excited about investing in. But there are 3 things we're looking for. The first and most important is long-term interest rates to peak. I think that came through a lot in the presentation. That's why the market's derating. That's why the ERP is not at an attractive level yet. You need long-term interest rates to peak. We actually think we're very close to that. And that's probably a tick at this point in time. Why? Because the rates that we're seeing are already starting to have an effect on the economy. Second thing we'd flag is earnings estimates to come down. Clearly that's going to happen this quarter and probably next. And from that point of view, you know, that's needed ultimately to solve the inflation problem. I mean, quite simply, we can see anecdotally solutions to the inflation problem. My target example is a classic solution to the inflation problem. But you do need these earnings estimates to come down, and it will be hard for the market to look through the valley of those earnings estimates without confidence that inflation's under control. Last and most important one is time. Sometimes you just need to be patient. Look, the reality is bear markets generally last 290 days. This is a bear market. We are roughly 130, 140 days into this one. A bear market normally on average falls 37% from peak. We're roughly 21, 22% through this one. And so you have to respect history here. You have to respect the history that this is generally the bit where some other things start to go wrong. You know, as Warren Buffett says, the tide goes out and you find out who's not wearing any bathers. And so you just have to respect that time issue. And we really would be looking for, you know, signs that, you know, companies reporting good results and going up and staying up for more than 2 weeks is always a good sign. VIX getting below 20 is always a good sign. Those are all sort of things you look out for that basically says that the risk appetite has improved, and that ultimately, we're getting near the end of this. And so from our point of view, we should respect that time issue because history has told us to do that. Last thing I'll just say here really quickly, like what else could actually go wrong? I know that, what are the other shoes that could drop? It is important to flag that there will be credit issues out of this. People have lent to property developers. They've lent to structured credit, mezzanine finance. There may even be some sovereign credit stress out of this. And so the reality is you should be on the lookout for those things that will cause the slowdown. It won't be anything like as bad as 2008, but you should be aware of it. Crypto is a new thing that we've never had to deal with. My great stat for this week is there's 2.5 million crypto accounts in Australia. There's only 10 million households. That means 1 in every 4 households has bought crypto. I think half the AFL football teams are sponsored by crypto. So from that point of view, you're going to see this sort of wealth effect that we hadn't seen before, not just the stock market going down, but crypto going down. And lastly, China and Taiwan, China lockdowns and Taiwan aspirations, these are things that you should watch. But ultimately less worried about that one, more worried about this one. Okay, so that's our view on the market. Hopefully that makes sense. Please don't be afraid to ask questions. There's a question box at the top. You can start typing them now. We're going to leave a good chunk of time at the back of this to answer any questions on that, because I know it's very, very pertinent to people right now, and any insights we can give, we're happy to give. What have we done at Munro Partners to deal with this situation? So what have we done to cope with this environment? This is just a good slide that shows, the portfolio over the last 18 months. So as a growth manager, you always have a choice. This is revenue growth along the bottom, and this is free cash flow on the side. And so put simply, you can basically pay a lot more money for a faster growing company, but you have to pay a higher valuation. We could put PE multiples here as well. And so from that point of view, you can pay, like I said, lots of growth, higher valuation, less growth, lower valuation. Now, the stocks in grey are all stocks that we've sold over the last 18 months. We sold most of them in March and May last year, and some of those early COVID tremors, early growth tremors that we saw at the start of last year. And so that means companies like Spotify, like Square, like Trade Desk, Atlassian, Twilio, and eventually PayPal all left the fund in the last 18 months. And most of them left before January. In fact, the vast majority left before January. Our strategy was, to gravitate back to these biggest and safest growth companies, these companies that we know can grow through the cycle and that will ultimately have earnings resilience in any slowdown. So that's companies like Visa, like Microsoft, like Google, like ASML, and like Danaher in healthcare and Thermo Fisher in healthcare. Why did we do this? Because we knew that rates had to go up. We knew that Big Bad Jerome was pushing this up. And so you want companies that can grow through the derating. You can grow through the derating. Now, this strategy worked very well in the second half of last year, but ultimately we got to January and things got worse. For the reasons I spoke about, the Fed was further behind the curve. Rates had to go up faster. And so we had more stop losses going off. As you know, we do run stop losses here at Munro Partners. We try to be very, very disciplined about this. More companies fell from peak, and ultimately we had to do more. And so in January, PayPal left the fund, Netflix left the fund, HelloFresh left the fund. We halved our Amazon position, we halved our Nvidia position. And so we continued to follow this process, which ultimately got us to this point where we had 40% cash. And so if I just scroll down here and show you this in real time, this is the net and gross exposure of the Munro Global Growth Fund over the last 6 years. As you know, we can lower the exposure. We did it here in 2018. We did it here in 2020, and we've had to do it again here in 2022. Also important to flag, we normally lower the gross exposure, so we don't want to pile on the shorts. We generally just want to take less risk in a difficult environment, just recognize that it's raining. And it really was those stop losses that got us down here to this net 60 number. And we've roughly stayed there pretty much for the last 5 months. And so from that point of view, I discussed what we were talking about in terms of putting the cash back to work. And I'll show you some of the places we're going to put it. But just very quickly, I just want to discuss how some of our hedging tools work through this period. And so what I'm showing you here is the attribution from our hedging tools in the December 18 quarter and also in the 2020 quarter. And the reason why we show this slide, and we've always shown this slide, is that every drawdown is different. Every sell-off is different, but the process we follow is effectively the same. So this was 2020. Our stocks went down in COVID, but our short equity return, our put options and currency all worked very well to give you, effectively no losses. It was actually a very easy correction to hedge because the market basically went straight down and it was very easy to know what to short. But as I said, not every correction's the same. This is 2018, much more like what we're going through in 2022. Your long equities go down, your shorts offset it, but not as much. So does your put options and as does foreign exchange. Now, at the end of the June quarter, we'll probably be able to update this because we would have got through most of the sell-off. But for the year to date, this year, our long equity book has obviously been weak, significantly weaker than we thought. In the end, being in Microsoft was not as defensive as you think. The stock's still down 25% for the year. Even Danaher's down. Even our healthcare stocks are down more than 20% for the year. So 60% of the long book, has still fallen nearly 20%. Offsetting that, put options have added about 150 basis points. Shorts have added about 100 basis points. And the currency, even up until very recently, had added very little because of the commodity point of view. Just to talk through a few of those really quickly, put options have obviously been difficult because the market has not fallen in a straight line. We have had lots of bear market rallies and lots of things to hedge. And on the short equity exposure, we probably didn't do good enough in the first quarter. In the first quarter, we were reluctant to short the high multiple tech companies. Why? Because they'd already fallen a lot. Secondly, we quite like some of these companies. And thirdly, had you shorted them a year or a year and a half ago, it was a very dangerous strategy. So we basically never bought them, or we sold them all. We never bought them after that, and we never shorted them. We just left it alone. Since the first quarter, short performance has got much better. It's got much better because we're now moving into a slowdown. We're now actually getting genuine earnings downgrades. We can target those downgrades and make more money. And so short performance has got better. And we are starting to short the usual things we short, things like advertising agencies, clothing retailers, construction equipment, et cetera, companies that we think are structurally flawed. And so from that point of view, short performance has got a little bit better. Putting that together, this is the performance of the Munro Global Growth Fund since inception. And what you can see here quite clearly is we are in a 20% drawdown. Frustratingly, that's probably a little bit more than we would like, but really roughly probably 5%, 5 to 10% more than we would have liked. And it's not beyond the bands of what we've actually done previously. We've actually had 5 20% drawdowns in the last 16 years. We had one in 2018, we had one in 2014, we had one in 2012, and we had one in 2008. And arguably, if you actually look at this, the fund is still actually achieving its double-digit return outcome through the cycle, despite the fact that we are at least halfway through our second bear market. And so ultimately, we think this actually sets up quite well. And I understand it's a little frustrating. The fund has leaked a little bit more than we would have liked, and we would agree. But ultimately, this actually sets up really well. You've had a prodigious growth sell-off. We have cash available on the sidelines. We see multiple great opportunities building here. And our goal really right now is just to really focus on these next 3 to 6 months, to stay prudent, to stay conservative, but ultimately set the fund up for the next 5 years of great returns. Our goal here is to not let this draw down much more, but ultimately, as I said, the opportunities that are going to present themselves are ultimately generational here. And we do see a strong outlook towards getting back to or continuing to keep this run of double-digit returns, purely because of the risk management stuff that we've had to do to date. And importantly, as I said earlier, the risk management stuff we do, every correction is different, but the stuff we do is always the same. It's always observe your disciplines, observe your stop losses, raise cash, and ultimately set yourself up for the future. Last thing I'd just say, and I want to be really clear here, it doesn't actually matter if you miss the bottom. Your average bear market lasts 290 days. Your average bull market lasts 64 months. So i.e. more than 5 years. This is going to be a bit of a tough bear market, but it is going to set up the next great bull market. If you miss the bottom by a month or even 6 weeks or so, it's not the end of the world. We actually did miss the bottom here in 2018. We still made 50% the next 2 years. And so from that point of view, I do want to stress this measure of prudence. We're not saying there isn't great value here. There is great value here. But it's just important to be very, very disciplined through these last parts of the bear market, because this is often where it can get a little bit worse. Hopefully it doesn't this time, but I just want to be clear that we want to be really wary of that. If you do think this is the bottom, then go and buy our long-only fund. It's fully invested today, ready to roll in some of the great ideas that we think are out there in the world today. But in the absolute return fund, we are really focused on keeping this double-digit outcome. we are really focused in not losing 40% of our clients' money. That's not what we're in the business of doing. And if anything, we probably already leaked a little bit more than we would have liked. Okay, so that's a quick update on the hedging. That's a quick update on the market outlook. In this last part of the presentation, very quickly, I just want to show you where we're going to put the money. Because very clearly, we do feel that there's a great opportunity presenting itself here. And I just want to very quickly point out the places that we'd put the money. And the first thing I'd say is that we're not going to go back out to this area, okay? So I know it's tempting to go and buy these fallen angels that have fallen 80% or plus, but ultimately we are in a world of less capital. That less capital will focus on the best opportunities. The best opportunities today are in the middle. They're the things we already own. These are effectively monopolies trading at low 20 times multiples that still have great structural tailwinds behind them. We've told you about these structural tailwinds for years. The biggest one is obviously e-commerce and cloud computing. Both these areas will continue to grow structurally. There's just really no reason why this is going to stop. They clearly accelerated through COVID. They're comping that acceleration, but it will continue. From our point of view, across digital payments, internet disruption, digital enterprise, and e-commerce, you want to stick to the big guys here. Don't go down to the smaller guys. They've lost their access to capital markets. They will have to merge with each other to compete with the big guys. And if anything, this actually helps the big guys because they don't have these competitors with free capital that they used to have. Generally, after a big blow up, it's normally a long time before these things return. This will favor these companies. So Amazon, Microsoft, ServiceNow, Google, Visa, MasterCard remain, are pretty much our core tech bets. Beyond technology, I just want to really quickly talk about climate. We ultimately do think we passed a tipping point here. We think it's going to cost roughly $50 trillion to decarbonize the planet. And that's $50 trillion that's going to be spent on a really diverse range of industries, whether it's renewables, passenger EVs, or energy efficiency. This is our climate universe where we split it into clean transport, circular economy, clean energy, energy efficiency, etc. And so amongst that group, there are some really good opportunities presenting themselves. Put simply, if you just look at the electric car market, you used to sell 90 million cars per annum. You're still going to sell 90 million cars per annum, but electric cars are going to inflect. That inflection is already happening in places like Europe and China. From our point of view, companies like On Semiconductor, which continue to upgrade earnings based on this shift, we're getting the upgrading earnings right, but ultimately the PE multiple is derating. Why? Because people think we're going into a recession. All this work we did to work out that they're going to beat consensus by nearly 40%, we didn't get paid for. That's the sanction of this market. But if the $5 goes to 10 and the multiple stays 11 times, then the stock's going to double. Or the multiple is going to go to 5 times. At some point, these stocks are going to go back to following their earnings. You just need the interest rate situation to stabilize and the inflation to stabilize. That's one good idea in that area. Beyond that, we continue to, we actually quite like agriculture. We see agriculture as effectively an unintended beneficiary of the climate crisis. Why? Because biofuels are effectively made with grain and soy. Carbon farming meaning farmers are actually paid not to farm. And the climate impact that I'm sure we're all aware of here in Australia means effectively you have a yield problem. And so from our point of view, we're interested in anything that's going to help solve the yield equation on the agriculture side of things. From that point of view, we would point to precision agriculture closest. And we could actually give you a cogent argument that, John Deere is the iPhone for a modern day farmer, with potentially 10% of its revenues coming from software at some point in the future. Here, the company we've invested in and our best performing stock this year is Nutrien. We actually bought it a year ago. We love it because of its retail business. It's close to the farmers. Agriculture is going to go through a sustained upcycle. Why? Because of what's happening with the climate situation. The other thing we'd maybe flag here really quickly is LNG. The other thing that we see happening a lot through climate is the energy transition is not smooth. I'm not sure why this is a surprise to people. Of course, it wasn't going to be smooth. There are going to be bumps and turns along the way. Within that, we see gas as a transition fuel. We see nuclear as a transition fuel. We find a lot of these companies, being valued like they're effectively like they're going to disappear in 10 years, and that's not the answer. This is a new company in the fund called Cheniere. It's been in for a few months now, but ultimately, as you shift to LNG, because LNG is a transition fuel, all of that LNG has to come from the United States, because that's the available source of gas in the world, and ultimately that goes to Europe, but that eventually goes to India and China, giving you a long structural growth runway of earnings growth down here that you don't actually have to pay for. Last area I'll just talk about really quickly that should continue to work through this environment is healthcare. Healthcare is effectively recession resistant. Most people will tell you this. Within this area, the one we're most interested in is vaccine, therapeutics, and diagnostics. We just have talked about this for a long time, and we see this strong shift towards biological drugs. Okay, so amongst the drug market, which is growing quickly, why? Because it keeps people alive for longer. Traditional drugs are losing share, biologics are gaining share. To make a biologic, it is effectively a culture. You need to grow it. You need all these cell culture equipment, this chromatography equipment, this filtration equipment. All of this equipment is very much often single use. You can use one vat and then you have to replace it. All of it is highly expensive, but these drugs obviously do a much better outcome for clients or for patients. The company we like here and have liked for a long time is Danaher. And again, this is what we're talking about, so you hear us talk about this all the time. And it is important to remember, at the end of the day, the earnings growth is going to drive the stock price of these companies. The only thing that's changing at the moment is the interest rate environment. That's causing the problem. Once that settles down, the companies will go back to following their earnings. This is Danaher. It's trading at 22 times PE. This is the earnings growth over time that we've been following for a long period of time, and this is the multiple. From our point of view, we see this company as a double-digit earnings grower for the next 5 years. If it still trades at 22 times earnings, you should make 10% per annum on this company. Now, yes, the multiple could go lower, but it can't go lower forever unless interest rates keep going higher and higher and higher. And as I said at the start, I don't see that happening. And so from our point of view, this earnings growth will ultimately go back to driving the stock price. The last thing I'd say here on Danaher, it is very much the same as what I talked about with big tech. These companies now have the opportunity also to buy all these smaller companies, to buy these technologies they're looking for, that they couldn't buy before, that will now underpin these earnings growth. And that's really is the big cap message that we'd be sending in this environment. Last slide, and I'll stop here and give us at least 20 minutes for some Q&A. At the end of the day, and I'll bring this back to the start, in sort of the journey you are on with growth investing, this is actually what you're paying us to do. So this is the slide that we put in every monthly and quarterly presentation. We don't like to show the fund by country or by sector because we just don't think it's relevant. At the end of the day, what you're asking us to do is to identify the areas of structural growth, being healthcare, 4 holdings of which Danaher is the biggest. If this is the right area of structural growth, and as I said with Danaher, their earnings grow structurally over time, then their share price will follow their earnings. That's what's happened for the last 16 years, and that's what will happen in the future. Innovative Health makes up 10% of the fund today. Food Revolution Agriculture makes up 10% also, which has Nutrien and Bayer in it. Climate, I talked about earlier, makes up roughly 8%. Below that, we have high performance computing. I didn't talk about it today, but we do think as you come out of his, the biggest opportunity in technology is actually in semiconductors. So as I said, we probably won't be going back to these fallen angels. We will be going back to the semiconductors in a fairly big way because they become the hardware, software platforms that actually drive us through the AI era. That's 8% of the fund today. That's NVIDIA, that's AMD, that's ASML. And this is definitely one area you should see get bigger. The other area we still like is cloud, digital enterprise. We have 2 companies here, clearly an area that suffered the most from the D-ratings. Again, this is starting to look interesting again now. The cloud is still growing at nearly 37%. It's not going to go negative. It might slow to 25, it might slow to 20, but it's not going to go to negative. The earnings for these companies will continue to grow. And you're now getting them, you're really at the lowest valuations they've been in a decade. And lastly, at the bottom is digital payments. The one safest investment through all of this is definitely Visa, because, there's 200 odd people on this call, and I'm willing to bet 150 of them about to head off on holidays. And so from that point of view, Visa is clearly a big beneficiary of that this year and will continue into next year, and is also inflation protected because it makes a percentage on the price of things that go up. And so just most importantly here, just to stress before we jump into the Q&A, look, in all of these areas, we see strong structural tailwinds, okay? Those tailwinds should equal strong structural earnings growth. And that earnings growth will equal share price growth. That is your path to double-digit returns. Everything else is just smoothing the bumps along the way. The process that we use to smooth the bumps is the same. The outcomes are different depending on the sell-off. But we have followed our processes again here, and I do think we are very well set up here to try and exploit some of these opportunities once the macro slows down a bit. And it's important to remember that the macro can't dominate forever, okay? It can be difficult for a while, but in the end, we know what the interest rate environment is. We'll know inflation is tamed. These companies will go back to following their earnings like they always have. And on any 3 to 5 year view, we think there's some really, really good opportunities setting up here. We just want to be a little bit prudent at this point in time to make sure we don't make this any worse. I'll stop there, Steve, and I see a few questions have come in. And from that point of view, happy to fly through some of those.
Yeah, great. Thanks very much, Nick, for the presentation. You're right, we've got some plenty of questions coming through, some really good questions. So we might start with more of the macro side of things, and then we'll head into the portfolio and talk about some of the stocks. So the first question is, does the Fed need to go above the inflation rate to break the inflationary cycle as in the past, i.e. during the Volcker era?
Yeah, it's a good question. It's a really good question because there are people who are saying this. Larry Summers and others are saying this. I think the Fed needs to go as high enough to lower inflation or to see tangible signs of inflation lowering. And so from our point of view, mathematically, it would make sense that they have to go higher. But if you actually look out the curve, to where the 10-year bond is, they are now saying that real interest rates are positive. So they have actually gone higher than where the interest rates are, and you have to assume the longer term interest rates are pricing in inflation expectations on that outlook. So they have actually gone higher. If you go further out the curve, you just don't see it here today. The other thing I'd just make point really quickly, there are tangible signs that inflation will slow. The question is just how quickly and how much damage we have to do along the way. The Target example I gave you is a tangible sign, i.e. they have to cut the price of their goods to move their inventory. The hiring layoffs, Facebook, we saw them in February, said they couldn't hire engineers. By May, they're saying they've got a hiring freeze. And I think by June, they'll be sacking people. And you will see the banks. You see the banks starting to let people go already because of the difficult environment they're in. So you are in a weakening hiring environment. So that unemployment's going to go up. And so you are seeing the tangible signs that the rates where they are today or the tightening of financial conditions is already having the desired effect. The last thing we'd point out is the commodity prices are starting to roll off. And so from that point of view, I don't think they need to go above the headline inflation level because they are already above it on any 3-year out or 5-year out view.
Okay, thank you. Given that governments of the world have literally spent trillions of dollars keeping everyone employed over the past 15 years post the GFC, do you think they are going to allow their respective reserve banks to push us into recession and cause massive job losses?
Yeah, it's a great question. I think they're stuck in a difficult position because we know that inflation is causing this damage. They have to kill inflation. And so I think their strategy is to go hard and go early now, which is ultimately setting up the opportunity that I'm talking about. And so from that point of view, they will eventually pivot. They always do. That would be your green light to buy the market. And actually inflation rolling off before that would give you a sign that they will pivot because they'll have the coverage to pivot. So they will eventually pivot. We will go back to a low rate world and a low growth rate world. I strongly believe that because nothing has actually changed here. It is hard to employ people. So population growth is not happening. We just don't have the GDP impulses that we had previously. So I do agree they will eventually pivot. The question is how much damage they have to do to kill inflation in the first place. And the problem we've got at the moment, as I showed you earlier, is more than we thought. The longer this stays up, the higher rates have to go, the more the slowdown is on the other side. And it will be hard for the market to look through that before it's even started, if that makes sense. And so from that point of view, I do think that that is eventually how we get to the end here. But that pivot that you might have thought was coming in May is now probably coming in September, October.
Okay, thanks, Nick. So just talking, maybe just a couple of things on the portfolio. So first of all, is there any part of the portfolio that is actually performing okay in this current environment?
Yep. So the main bits that have done well for us is the agriculture part is mainly positive this year, which is I mean, we would argue performing okay. We don't really talk relative, we talk making money. So the agriculture bits made money this year. And aside from that, the Visa, MasterCard have been pretty good this year as well, but I think they're closer to flat. Below the line here, we have some new investments in things like defense. So we only show the top 6 here. We have made some investments in defense stocks this year that have been quite successful. We do feel that defense is people are now learning that defense is a necessary part of a free and functioning economy or democracy. And so from that point of view, after the invasion, we did make a couple of investments in defense stocks. They've done well for us as well. So those are the main areas. And then the obvious areas that have done well or starting to do better now is the short side as well, which is starting to add value, and the hedging side, which has started to add value. But aside from that, the reality is and actually I'll show the slide actually just to be fully transparent. This is actually the attribution year to date of the fund, to be fully transparent. And what you can see is where we've lost our money is actually in the companies that we've owned in some cases for a decade. Not one of these companies we don't see getting, producing record earnings in the future. And not one of these companies we don't think will ultimately follow their earnings in the long run. And so from that point of view, a little bit frustrated, to be honest, that Danaher has been as weak as it has been this year, because there's basically nothing's going wrong. Or Microsoft has been as weak as it has been this year. Clearly, we've had problems at Amazon and Nvidia. We did reduce those positions. But, one of these stocks is a utility. And so what you won't see on this slide quite clearly is you don't see us doubling down on PayPal. You don't see us doubling down on Netflix. They all actually left the fund in January. You don't see Snowflake in here. All stocks that we did own. And so from our point of view, we have followed our disciplines through this period. We've held on to the core stocks and reduced them. We still think these core stocks are absolutely fine. And these are some of the things that have done a little bit better for us. And down the bottom here, you're seeing the things that we're taking the opportunity to buy here, like LVMH is one company that we've recently added to the portfolio that we've liked for a long time, and we're getting the opportunity to buy it. That sort of gives you, the full transparency, and happy to share that with you.
Okay, so Nick, just you mentioned agriculture, so this is a good question. A cow is something like 4% efficient, and something like 50% of all grains feed animals. If plant-based protein meats replace a large proportion of animal meat, and the amount of farming land required to feed the world will reduce dramatically, the likes of John Deere could potentially plummet. Are you concerned about this?
I think when we look at the agriculture companies, we see grain prices that are going to stay stubbornly high. And I get the cow bit, the protein bit versus the grain bit, but you're still going to need a lot of grain to make this plant-based meat. So you see grain prices that stay stubbornly high, and if you look on this picture here, you need technology to help solve the yield equation, because the amount of land you use is going to be less or the same. That's how we're thinking about it. And the technology that's provided that can help here, is integrated into the hardware of the equipment, which makes it better equipment, which allows them to trade a premium. So we've seen this before in lots of other industries. And I think from our point of view, we ultimately think that this is why we like the area. I understand that maybe we don't need as much land. That hasn't been the case. The yield equation has been a good investment for a very long period of time. It goes through a cycle. We would argue that cycle is now going to be elongated. And so that's why we like John Deere.
Okay. You also spoke about a bit of attribution before. So this is a question that feeds into that. And that is, can you elaborate on the stop loss functionality?
Yeah, so the stop loss functionality, most importantly, just to show you really quickly. Okay. So our goal is to identify the areas of structural growth and identify the winners. If we can find the winners in those areas, that structural growth will equal structural earnings growth, will equal structural share price growth. Any company that falls 20% from peak or from cost is subject to a review. That review is we have to repitch the investment case. And so how a lot of those companies left the fund is because many cases, they fell 20% from peak, i.e. we had made a lot of money out of them, but they had corrected. What generally happens is we go, oh, it's just the market, or it's, they've got a rights issue coming up, or people don't understand this. It's going to be fine. And we might decide to keep it. We don't have to sell it. We might decide to keep it. But if we do keep it, we can only keep it for a maximum of 30 days before we have to review it again. And then we have to review it again, and then we have to review it again. And so what eventually happens, which is what happened to the Chinese stocks last year, or happened to PayPal, which we liked a lot, is by the time it's on the third review, everyone's having a look at it, trying to work out what's wrong. And in PayPal's case, thankfully, we did work out what was wrong. They'd had a take rate issue, had competition around the button. And so we sold it, and we feel bad selling it down 30%. We would have preferred to have sold the top. But the reaction function, the stop losses, made us look at it. In the end, PayPal warns and then warns again, and it's down 75% for the year. Same thing happened with Alibaba and Tencent a year ago. That's how we ended up getting out of China. Same thing happened with Netflix, where, we looked at it, we reduced it before the result, and then we sold it after the first warning, and we didn't buy it back. Why? Because it had triggered. And so we just find this is a really, really good discipline. It's a really good discipline that ultimately creates this picture. These are our top 10 winners in basis points contribution to the fund since inception. And these are our top 10 losers in basis points contribution to the fund. And so you'll see, even after everything we've been through, we have actually never lost more than 100 basis points in any one stock for this fund in 6 years of running money. Uber, we lost 100 basis points twice, and I'm still angry about it. Going into COVID and coming out of COVID. Let's not talk about it. But here's the reality. The goal is to find these few winners and run them for long periods of time. The second thing to do is to be disciplined about your mistakes. You're going to make them, okay? Things are going to go wrong, case in point. But we're not sitting here going to say we're just going to keep doubling down on these things and make the situation worse. There's no point dying in a ditch over Teladoc, okay? It's just not worth it. Your goal is 10% per annum for your clients. Your goal is to find those winners. And okay, sometimes you might just say, let's just step to the sidelines. We don't really know what's going on here. Let's step to the sidelines. We can always come back. Our mandate allows us to do this. We can hold up to 100% cash. And so that's how we think about stop losses. And that's why they've helped us in this situation, because we came into the year with the wrong strategy. We did. We thought the big caps would be fine. They weren't. We thought PayPal would be fine. It wasn't. But it ultimately has allowed you to avoid all of these mistakes and, more importantly, not double down on them. Last thing I'd just say is you probably noticed on the attribution, there are some stocks there that have clearly triggered this year, i.e. they've fallen 20% from peak and they've been reviewed. As we are reviewing them, we are reducing them. So Amazon has been run, as you know, has been the biggest position in the fund for a long period of time and actually one of the best performers. It's been run at half weight most of the year, and it's even below that today. We still really like it, but we're just running at a lower rate. The same with NVIDIA, which is in the top 10. We like it a lot. It's obviously pulled back. We're trying to manage that position because we really like it in the long run. We are reviewing it at every stop loss and deciding if anything's changed. And in the medium term, we don't think anything's changed for those companies. But for PayPal and Netflix, it did. We recognized it. We moved on. For HelloFresh, it did. We recognized it. We moved on. And so it's not perfect, but it does help us. And it gives us the discipline that we need to navigate these periods. And I think that's really one of the key differences here. And I want to try and flag this. You have a lot of growth managers you can choose from. If I want to say one thing, Munro Partners is a growth manager with discipline, okay? We take this very, very seriously. Investing is a game of conviction and discipline. And all you got to do in these environments is like turn the conviction down and turn up the discipline. That'll help you get through it. And so from that point of view, while not everything's gone exactly the way we wanted it to this year, we think we followed exactly the same processes that have got us through previous corrections. And we think it'll get us through this one as well. And ultimately sets you up for the good times, which is that 64 months of bull market that is ahead of us at some point. And I personally can't wait.
Great. Nick, a question on Tesla and also on Elon Musk. So do you still have Tesla in the portfolio, and your thoughts on Musk buying Twitter?
Okay, so here's my good joke I heard while I was in the States. So Musk buying Twitter is a bit like the dog who caught the bus. He was barking at it and then he accidentally caught it. What this is doing is creating a good opportunity to potentially buy Tesla. We don't have Tesla in the fund today. It is a very high multiple stock. We have a model on it. We have a number that we're looking for. And that number is around $600. That would be the number that you might see us. It's got very close to it a couple of times. And I do think we'll get the opportunity. And I think anything $600 or below, you might see us making a start on Tesla. We really like Tesla, the company. We understand Elon's a bit crazy. That's just how these people are, quite frankly. You just got to get used to it. And ultimately, it's giving us the opportunity we're looking for on a company that we think is potentially one of the big climate winners into the future.
Okay, we're running close to time, but there is one question here I think it's worth asking. That is, just before we go, are you looking to buy back into Chinese companies yet?
The answer is no. The short answer is no. And the reason why I say that is because, we have trouble with the corporate governance. We're not against China as an economy. We think it will grow. We think they'll come out of lockdown. I showed you earlier, we bought into LVMH. So we're not against Chinese economy. Starbucks looks interesting down here, as does Nike. But we have trouble with the governance of Chinese companies. We're just not 100% convinced that they're working in our interests. China for years has done this great trick of, we'll take your money, but we won't necessarily listen to what you want us to do. And I just think in an ESG world around governance, that trick's not going to work as well, quite frankly. They're going to be, if they want your capital, they're going to have to do better on some of this stuff. Last thing I just say is, as I said at the start, you can buy monopolies now, right? You can buy monopolies in low 20 times earnings. Google's 18 times earnings, okay? Tencent's actually above that, So why would you pay a premium for Tencent when you can buy, monopolies in a free democracy that are buying back shares, that are paying, in some cases, paying dividends, and incredibly well set up into the future. And you just don't need all that grief. And so from our point of view, we're not. Maybe things will change at the top and they'll start saying more of the right things. They're going to have to say probably a bit more of the right things for us.
Okay, Nick, now there are some more questions, but unfortunately we've run out of time. So for those people that have asked questions and we haven't answered those yet, we will come back to you. Nick, just before we wrap up, is there any final comments you'd like to make?
Yeah, look, so thank you very much for dialing in. As I said fairly quickly, it's obviously a difficult time in markets. I just encourage you to use our website and our transparency. We've tried to be very transparent here about the things we've done, the process we've followed, and the outcomes that have achieved. We do think this actually sets us up really well for the future. As I said at the start, it is invest in the journey with Munro Partners. The team, we have redone our website here. The team have done a really good job of creating videos and insights, a lot of what I just went through. Look, we understand for every, frustrated advisor, there's a grumpy client at the other end. And please do use these materials to help understand what we're trying to do, why these companies will grow structurally for a long period of time, and why when their earnings grow, eventually their share price will just follow their earnings. And that's the exciting stuff that we have to look forward to. And in between, we're going to try and manage the bumps for you. And please do use those materials, and we really appreciate you dialing in today. And I'll hand it back to you, Steve.
Yeah, great. Thanks, Nick. And look, on behalf of all of our clients, I'm sure they'd just like to say thanks very much for your time today and providing that update, which hopefully they can then pass on those key messages to their clients, in the coming few weeks and months. So thanks very much, Nick.
Thanks, Steve.
Ladies and gentlemen, thank you very much for dialing in today. We hope you found the session useful. So once again, look, thanks very much. As Nick said, please go to munropartners.com.au or gsfm.com.au for more information. We do really appreciate your ongoing support, and we look forward to keeping these updates coming through in the months ahead. Presentation packs will go out shortly along with CPD points in the coming weeks. Thank you very much, and please enjoy the rest of your day.